Well, greetings and salutations, Series 7 test takers. This is the Series 7 Guru coming to you from my off-grid studio, getting our kicks on historic Route 66 with another explication request. If you have an explication request, you can send it to explicationrequest@guruexamprep.com. Good morning, Dean. Could you please help me understand this question? Of course. An investor establishes the following positions: long 1XYZ April 40 call at 6 and long 1XYZ April 50 put for 8. This is a straddle with different strike prices known as a combination. And what you're buying here is volatility. It says that both options are sold for intrinsic value. And that's why that concept of intrinsic value is important, because they like to say on the test, you close out for intrinsic value. And if you don't know what intrinsic value is, you're not going to be able to close it out, right? So always fire up the T. Fire up the T. So we're going to make the T here to track the money in and out. A lot of ways to do options. Some people like pluses and minuses. But the T is tried and true to answer any options questions. If you can get good at contract specifications, in other words, you're not struggling that this is a choice to buy the stock at 40 and a choice to sell the stock at 50, and you can track money, you're in pretty good shape. All right, so let's track the money. We got a 40 call and a 50 put. Boom. We paid out 6, we paid out 8, and now it says we close out for intrinsic value. So we're doing our closing sale here. It says the options are sold. So that's important that you know what the offset is. If we're buying, the offset is to sell. And we're doing it at intrinsic value. Call up. Call up. If the market price of the stock is above the strike price of the option contract is in the money, it has intrinsic value. So the intrinsic value, the in the money amount, those are synonymous, of a 40 call with a stock at 44 means we're going to close this out for 4. In the real world, there'd be some time value, but as I said, as a fiction on the test, they say close out at intrinsic value. Call up. Put down. If the market price is down from the strike price, a put contract is in the money and has intrinsic value. So the intrinsic value of a 50 put with the stock at 44 is 6. So that means we closed it out for 6. And this is the beauty of the T. Now all we do is compare money out with money in, and we are unhappy. We're unhappy because we got more money out than in. It didn't go either above 54 or below 36, our break even, so we're losers. So we lost 4 points, and 4 points on 100, one contract governing 100 shares is $400. Now, in the test, they would never give you an option of 4 points in choice A and then 400. It'll be one of the others, 4 point or $400. So hope that was helpful. This is a combination, a little challenging, and it asked you to close it out at intrinsic value. Remember, inch by inch, combinations are a cinch. Yard by yard, combinations are hard. And I will see you for the next explication request.